Welcome back to the best prop for you trading floor. Today we are looking at the rebound of WTI oil from 62 all the way up to 64.50, which is staging a critical rebound. If you are in a best prop for you challenge right now, you have to listen this closely. Oil is trading on pure geopolitical headline risk ahead of the FOMC minutes and also the EIA data tomorrow. This is the exact type of environment where forced trades blow accounts. We are seeing a potential breakout pattern, okay, at the Upper Bollinger Band, but with these two events tonight and tomorrow, the market is coiled. So let's break down the why and how so you can trade this volatility without ruining your drawdown. First, why the bounce? Well, WTI yesterday actually fell all the way down to 62 due to rumors of successful talks in Geneva today. However, the reality is that the gap between Zelensky and Russia remains massive. So there was no breakthrough, and that led to tension, and the risk premium in oil led to this upside. But don't just stare at the war headlines. Tonight we'll have the FOMC minutes. So if the Fed sounds hawkish, the dollar rips and oil could face headwinds. The initial support that we need to pay attention to is at 63. And the secondary support, or more major, I would say, is down at 62. We could still see a consolidation based on what happens also during the EIA data tomorrow. But if the Fed sounds cautious, the dollar drops and oil, which is priced in dollars, gets a green light to push higher. Then again, we'll have the EIA inventories tomorrow. Analysts expect a build in crude, but a drop in gasoline. So the data will confirm or deny a potential breakout. Now, let's just focus a little bit more on the charts. I am tracking a pennant pattern. We have had a higher low with divergence, and we do get lower highs as well. Equally, a short-term divergence on the RSI, and that is the reason the focus today is on momentum, which of course has driven prices to the upside, to the Upper Bollinger Band. Interestingly, if you pay attention to the RSI, it's just down at 60. So on the 4 hour, this means that there is room to run towards the 70 level. And this could be suggesting that we ought to see prices moving all the way to the upper trend line of this potential pennant pattern. Pennants are 3-wave patterns. So if we do see prices moving up here and getting a rejection, we could see another leg to the downside, and then a triangle pattern might be the one that might form. So we have the bullish divergence, however, and we have RSI that can still go to 70, along with currently facing resistance, which is our only capping point for now before we go to the upper pennant trend line. So here's where you need to pay attention for your challenge. If this pennant breaks to the upside, our first target, of course, would be the previous swing highs at 65.80 and then 66.50. However, where it gets interesting is that the measured move, which is the projection of the opening of this pennant pattern from the breakout bond, is sitting right at 70 mark. Yeah. However, in between, we do have the 67.50 and the 69. A squeeze over here, because we do see currently the two Bollinger Bands are actually pushing inside towards the middle line, right? A squeeze usually leads to a breakout indeed. But in this geopolitical minefield, false breaks are common. And just to give you an idea, we already saw a false break while doing this pennant pattern. Okay. This is how you trade this without blowing your best prop for you account. The kill zone. The kill zone is the median line of the Bollinger Bands. So we are looking at 63. This is the line in the sand. If price fails at 64.50 and drops back below 63, the bullish setup would be invalidated, at least for the short term. A close below the median line would trigger a full reversal down to 61.20, okay, and eventually to the 60 support. Why the 60? Because if we do use our Fibonacci tool again and assume this is a correction, the 100 Fibonacci to the downside gets us to 60. So we are at this stage in the trend of oil markets that if we see a breakdown, we are looking at support at 60. And if we look at a break to the upside, we're looking at resistance at 70. But do not simply buy the breakout because it looks good, right? Wait for the close. Let the 4-hour candle close above the pennant, okay? Or on the other side, below the median line. And don't forget, we still have the risk of a double top potentially forming at 66.60. Tonight's FOMC minutes will bring volatility, likely, but it might be a non-event. So cut your loss size in half. You don't need a full position to, speculate on a $5 order move. And if you're long, your stop might need to be just below the 63 level. If that breaks, accept the small loss and leave the trade tomorrow. So keep your eyes on the headlines and that 63 level. The Geneva talks failed. The Fed is on deck and the technicals are coiled ahead of the EIA report tomorrow. Do your own research on the news, stay disciplined and manage that risk. This is best prop for you. Trade smart.